everyone, welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, Economic and Market Research Analyst for TMX Verify. Today we're diving into a powerful tool for long-term stock market valuation, the Buffett Indicator, also known as the market capitalization to GDP ratio. Warren Buffett himself called it probably the best single measure of where valuations stand at any given moment. The indicator is simple. It's the total market value of all publicly traded stocks divided by a country's GDP. It helps gauge if the stock market is undervalued, fair valued, or overvalued. Our data for this indicator goes back to the mid-20th century, using the Fed's Z1 report for corporate equities and nominal quarterly GDP. Now let's look at the latest reading. With the second quarter's final GDP estimate, the Buffett Indicator now stands at 215.6%. This is one of the highest levels on record and is clearly signaling an overvalued market. A key observation in this next chart is the upward trend of the ratio over the decades. To get a better sense of current valuation relative to its historical path, we can detrend the data. By detrending, we remove that long-term upward bias. We can now see how far the current reading deviates from its own historical trend line, using standard deviations to define valuation zones. As of the latest data point, the current Buffett Indicator rating is 56.5% above its trend line. That places it approximately 1.8 standard deviations above the trend, firmly in the overvalued territory. While the Fed data offers a longer history, some prefer a more intuitive measure for the numerator. This chart here uses a popular alternative, the FT Wilshire 5000 Index divided by GDP. This shorter-term variant, starting in 1989, provides a highly transparent snapshot. Using the Wilshire 5000, the current variant is at 187.6%. Looking at the two versions, the Fed's Z1 ratio and the Wilshire 5000 ratio, over their common time frame, starting in 1989, we can see that they are highly correlated. Though the Fed data has slightly more volatility, they're essentially telling the same story. Now, a common question is whether using gross national product, GNP, instead of gross domestic product, GDP, as the denominator provides a more accurate picture. When we switch the denominator to GNP, as shown in this chart, the results are remarkably similar. The latest reading here is 215.7%. I want to close out with this point. While the Buffett Indicator is a powerful general gauge of long-term market valuation, it's crucial to understand its limitations. This overlay here with the S&P 500 index makes one thing very clear. This indicator is not useful for short-term market timing. Markets can remain over or undervalued for extended periods, and thus this method is best utilized as a signal for a long-term investment strategy. That's all for our discussion. Thank you for tuning in. For more economic and market insights, you can find my content on the Advisor Perspectives website under the AP Charts section.